The lead speaker for the panel on the IMS in a changing global landscape will be Professor Charles Engel from the University of Wisconsin. So please.
Well, thank you very much, and thanks very much to the International Monetary Fund and the Swiss National Bank for organizing this conference. It's been really productive and informative. So this session's on the future of the international financial system, and we're going to follow the same ground rules as before. That I'll have 15 minutes of introductory comments, and then I've been told to strictly enforce the 10-minute limit on our distinguished panel, but then I haven't been given any enforcement tools, so we'll see how that works. Being an American, I might threaten to impose financial sanctions, but being American, there's nothing, no sanctions can be imposed on me, so we'll see how that goes. So it would be presumptuous of us to try to forecast the next 75 years of the international financial system. What we can do is discuss the factors that are currently effecting change in the international financial system. And one of the major factors, of course, is financial technology. So fintech offers the promise of making the international financial system more efficient. It could speed international transactions in finance and facilitate international trade and potentially increase financial inclusiveness. But then it poses challenges for the implementation of monetary policy and certainly for financial regulation, for policies dealing with financial crises, and it brings serious concerns about cybersecurity. Now, a particular set of concerns has arisen over privately issued digital currencies. And again, the questions are whether those digital currencies could actually supplant central bank currencies, but maybe more importantly, how do they affect monetary policy transmission? How do they affect the payment system? How do they affect financial stability? Now, in my limited time, I am going to just focus on one aspect of these changes, which has gotten a lot of attention at several central banks, which is the possibility of introducing central bank digital currencies. And my remarks here are really just a short summary or a survey of the literature that's been written, a lot of it by the central bank economists, but also academic economists. And I'm going to focus in my remarks on the so-called retail CBDCs, that is the digital currency deposits that would be available to households and firms. And I'm not going to really discuss the possible benefits of these accounts in speeding settlement of transactions. And instead, I'm going to focus on the investment characteristics of CBDCs. So in particular, the central bank digital currencies offer an opportunity for investors to hold another form of a safe and liquid asset. And so what do I mean by a safe asset? Well, that's an asset that has low default risk, that has relatively stable value, and an asset for which there's very little private information so that the buyer of the asset can be confident that he is not getting cheated. A liquid asset is an asset that can be used sometimes to make transactions, or at least it can be used as collateral, and it's an asset that has a deep market so that it can be sold easily even during times of turbulence. And so I think we can say that safe assets are liquid and that all liquid assets have the characteristic of being safe. Now, it's generally viewed that for a well-behaved government that those assets are safe and liquid. And I want to categorize the liabilities of the government, and here I mean the consolidated balance sheet of the government, including the central bank balance sheet, and begin then by listing some of the properties of these different liabilities and how central bank digital currency would differ from these other government liabilities, but all of which I presume have some aspect of safety and liquidity relative to privately issued assets. So currency is is a very liquid asset, but it's also a cumbersome asset for making transactions, and it's very cumbersome as a store of value. I mean, that's why we've been able to drive interest rates below zero in some cases. Currencies don't pay interest, and on the other hand, they can be used easily in transactions, and importantly, they maintain anonymity. Now, reserves, and I'm talking about here reserves held at the central bank by private banks, are, of course, very liquid, and they pay interest, but their drawback is that they're only available to banks. Bonds, government bonds, are considered to be liquid and safe, but not as liquid as currency or deposit accounts. They do pay interest. So where does a central bank digital currency come in? Well, they could take two forms, and I'm not going to spend much time here on the token-based CBDCs. You could think of these as sort of a digital Bitcoin or a central bank Bitcoin. And so one possible advantage of a token-based CBDC is that it can maintain anonymity. It could be designed that way. It doesn't have to be designed that way. And indeed, I mean, it seems unlikely to me that there are many central banks that would want to issue yet another asset that allows anonymous transactions. I mean, many central bankers feel there's already too much of that going on. The other drawbacks of the token is that it's difficult to arrange how to pay interest on a token. And then some of the studies have discussed the possible difficulties of maintaining parity of a token with the physical currency. So I'm going to set those aside and mostly now focus on CBDCs that are a claim to an account at the central bank. And we can think of those, they're sometimes called reserves for all. And the idea is that the public, the households and businesses would have access to accounts much like reserves. They would be, of course, liquid. They possibly could pay interest. They're a less cumbersome asset than cash, and they can be used in transactions, but they would not be anonymous. So one of the main rationales, I would say, for creating such an account is to give the private sector access to an asset that has the same safety and liquidity characteristics as reserves, which otherwise is not currently available to the general public. So what are the competitors? What is available to the public? Well, the privately issued assets, for example, deposits held at banks, are an obvious alternative. And as many of the studies have pointed out, and don't take offense when I say this, but the private sector may be better at creating new products and may be more efficient and less bureaucratic than central banks. And so they may have an advantage over central banks in that regard. But they have the problem that they are not generally considered, deposits at a private bank are not generally considered as safe as deposits that would be held at a central bank. Now, there are insured deposits, and so they have the backing of the central bank, but there are limits on deposit insurance, and besides which deposit insurance has its own drawbacks as a means of providing safety, because then they create moral hazard on the part of the private banks because the depositors have less incentive to monitor the behavior of the private bank. Now, another possibility that's been floated is starting narrow banks. So narrow banks are banks that would take in deposits and invest them entirely in reserves, and that way depositors would have an additional degree of safety, I mean, they're still not as safe, I would say, as an actual central bank deposit because you still don't know exactly what the owner of the narrow bank is up to, but they have a lot of the same characteristics. But there is one drawback that I'm going to mention in a few minutes. And then there's the hybrid accounts, which are basically accounts that would be established at current banks, but would be somehow segregated, and these accounts would be backed 100% by deposits, reserve deposits held at the central bank. So those would have a lot of the same characteristics as a narrow banking proposal. So first of all, what's motivated this interest in central bank digital currencies? Well, I think a lot of it was motivated from the fear that the central bank currencies were going to be replaced by digital currencies. Now, my own opinion is that fear is unfounded, or at least it's premature, because digital currencies, first of all, have not been very useful for making transactions. As we know, the value of the digital currencies has fluctuated pretty wildly. And in any case, digital currencies still really don't replace a central bank currency because they don't function as a unit of account. Goods and services are priced in central bank currencies. We have dollar prices or euro prices of goods. We don't have, if you go to the store, there are no goods that are priced in Bitcoin. So if you're a Bitcoin holder, you're still, in a sense, taking on foreign exchange risk if you want to then use your currency to buy goods and services. So what are the benefits then of a central bank digital currency? Well, as I said, it gives the non-bank sector access to a safe and liquid asset with the same characteristics of reserves. It's been argued that in some countries it's going to improve access to the financial sector. For governments, it may be a less expensive way to finance debt because you can pay a lower interest rate on CBDCs than on short-term debt because of their liquidity properties. And in essence, it may be that a country that issues a CBDC can capture some of the exorbitant privilege that the U.S. enjoys. The U.S. has enjoyed the ability to issue debt at a very low interest rate because U.S. Treasury bills are considered to be safe and liquid. So possibly other countries, by issuing a CBDC, could capture some of that exorbitant privilege. Now, there have been concerns about CBDCs, and some of them, I think, are a little bit overemphasized. So one thing is that if the private sector has access to a CBDC that pays interest, then commercial banks would have to pay a higher interest rate in order to attract deposits. That, in turn, may lead to higher interest rates charged to businesses for loans or to households for home loans. But I think all of that is a little bit overblown because the central bank could always offer a low enough rate on CBDCs to keep market interest rates low. It's also been argued that CBDCs could cut into bank profits. Some have argued, well, that's a good thing, that it's monopoly profits. But in any event, I think that is also something maybe that central banks could control by, in effect, subsidizing the private banking sector by offering higher rates of return on reserves. Now, if the CBDC was issued as a zero interest rate deposit, it's been argued that would put a hard zero lower bound on the effective lower bound. Now, central banks can set interest rates a little bit below zero because of the cumbersomeness of holding large amounts of currency. But if there were zero interest central bank digital currencies, then it would be difficult or really impossible to push the interest rate below zero. But the main concern that's been raised about CBDCs is what would happen in a financial crisis. So it's been argued that there would be a run to safety to the central bank digital currency. Now, there have been counter-arguments to that. One is that central banks could lower the interest rate, possibly well below zero, although I think politically it would be difficult for central banks to be offering the public accounts with very negative interest rates. Alternatively, during a time of financial crisis, the central bank could simply limit inflows to to the CBDCs. Or, alternatively, if money is flowing into the CBDC, that could be recycled to the private banking sector through the discount window or other forms of loans. So it's been argued that that's not a conclusive argument against CBDCs. Now, here I would mention that this is an issue if the narrow bank takes the role of issuing these safe assets, because the narrow bank, privately owned narrow bank, doesn't have the same incentive for the stability of the financial system that central banks do. And I think this is kind of a major drawback to the narrow bank proposal. Finally, I would say that another issue is if it were the U.S. dollar that was took the form of a CDBC, that I think there would be concern in the rest of the world that relies on dollar funding, because I think that the Fed would not necessarily have the financial health of other countries' banks in mind, and so they may be less active in protecting other banks during banks in other countries during a financial crisis. So let me conclude: should a central bank create a CBDC? And I think it's up in the air. I would mention that I think that there will be an early mover advantage, that whoever first offers one would attract a lot of deposits from the world. They would have sort of their own exorbitant privilege, but being the first mover, they would also incur a lot of risks from the unknown aspects of the CBDC. And I'll stop here. So our first panelist is Tobias Adrian, who is the financial counselor and the director of the Monetary and Capital Markets Department of the IMF.
Great, thank you so much. Just a year ago, all the talk was about crypto assets, Bitcoins, and its multiple evolutions. And today, I'm going to shift and talk more about e-money. In particular, I'm going to focus on stable coins and how they relate to central bank digital currency and what it might mean for the international financial system. So I've written up my remarks in a kind of speech that is on the IMF website in case you want to go into a little bit more detail. So I'm going to broadly talk about e-money. And what I mean by e-money is that it's a means of payment and store of value that is fully backed by fiat currency. So it is the digital equivalent of a prepaid card, and there are many different forms of e-money. It could be in token form or in account form, and it could be centralized or decentralized. So one particular e-money that I'm going to focus on are stablecoins. So stablecoins are token-based coins that are fully backed by the fiat currency in some bank account so that they overcome a lot of the problems that Charles was pointing out about the crypto assets. So these are stable in value, and they can be used for transfer in the digital world basically for free. So the transaction costs are extremely low. So examples of e-money, so these are all different types of e-monies, for example, WeChat Pay and Alipay in China, M-Pesa in Kenya, Bitcoin in the Caribbean, or the US dollar coin of Coinbase and Circle in the US. So for example, in Kenya, 90% of the population is using M-Pesa. In China, something like $18 trillion of e-money transactions have been done, which apparently is more than what Visa and MasterCard did combined. So e-money already has a big presence in some countries around the world, and there continues to be innovation in this area. So as I said, the advantage of the e-money is that it's stable in value, so it doesn't have the Bitcoin problem where the value of your supposed coin is 3,000 one day and 6,000 the next day, or vice versa, which is worse. And of course, e-money is completely integrated into the digital life, right? To the extent that you are probably the younger you are, the more your life is totally digital. And so e-money is integrated in internet companies, basically. The transfer of e-money is near costless and immediate per construction. And in principle, because these are fully backed coins, there should be trust in these coins, right? There are network effects as well. In principle, size helps a lot in this marketplace. Of course, these are not riskless. There are lots and lots of risks. So at the IMF, we worry about all of the risks all the time. So the first one is that perhaps the e-money is not fully backed. There are incentive problems, as Charles pointed out. So, as a company that is offering e-monies, you always have an incentive to under-collateralize your coin. And who is there to really check that all these funds are out there? Secondly, there's credit risk, right? I mean, presumably the issuer of the e-money also does some other business. And if that other business goes into bankruptcy, your collateral, your e-money collateral could be absorbed into these other parts of the bankruptcy proceedings. And thirdly, there are interoperability problems. So it might well be that Charles and I were on the same platform and we can make payments, but Ahmed and I, we are using different platforms and we can't make payments. So how does interoperability work? Of course, within the traditional financial system, this has been solved, but in the new technology, this hasn't been solved. So one solution that you could propose, and here, this is where I move towards CBDC, is that, of course, central banks could come to the rescue. So they could solve all three problems that I pointed out. So number one, they could somehow certify that there are enough reserves. So imagine that there are stable coins or so, or some other e-money, where the reserves are not held by a private bank, but somehow either by a central bank or by a specialized intermediary that can hold reserves with the central bank. So at that point, such a specialized license could have a check on whether the money is fully backed. So that would solve problem number one. Problem number two was about the credit risks. So there could be some legal provision that basically whatever reserve you hold against your stable coin would be exempt, would be super senior in bankruptcy. So that's the second problem. And then the third problem about interoperability, well, this is core central banking business, is to ensure interoperability. So there could be in principle some standards that would make sure that Charles and I and Ahmed and I, we could all sort of like transfer these e-monies due to standard setting. So what I've described is a form of synthetic CBDC. It's not the pure CBDC that Charles described. So what I have in mind are some sort of stable coins where reserves that are fully backed by reserves, and those reserves either directly or through an intermediary, a specialized intermediary, are held with the central bank. So it's synthetic CBDC because the central bank is not involved in any of these businesses of actually running a coin. This is completely outsourced, but they do make sure that there's enough backing, enough reserves, and they do make sure that there's interoperability. All of the risk management, the KYC, AML, CFT problems, and the marketing, all of this is done by some companies. So de facto, this synthetic CBDC is a kind of public-private partnership in some sense. Now, this all sounds good in some sort of closed economy, but once we think about the open economy, this is becoming a lot more difficult. So even if it was the case that, say, in country A and country B, you could have stable coins where the reserves were held with a central bank or with an intermediary that was holding them at the central bank, you would still have the problem that if you wire money from one country to the next country, you would somehow have to readjust your reserves. And how do you do that? Well, there you're ending up with some sort of correspondent banking problem, right? Because now your reserves that are held with one central bank have to be transferred into the other central bank. And at that point, how do you verify that you have enough reserves in the right currency Would you perhaps concentrate just on the major currencies and leave out smaller currencies? And would there be a counterparty credit risk because your foreign counterpart might not be under the same law and under the same regulations as the domestic counterpart when you're transacting across borders? So there are a host of issues about fragmentation, again, interoperability, correspondent banking that are coming up. One particular risk that I want to point out, and this is true even for the stable coins that are present today, so even if stable coins are not backed by CBDC, is a higher risk of dollarization. So there's a natural bound to how much dollarization you can have in a given country, because typically transaction costs are high, and it's actually difficult in a foreign country to say transact in dollars or in euros or in renminbi or so. Once you go into this digital world, dollarization is a lot easier and is potentially a lot cheaper. And so this could undermine monetary policy in countries where there is a push towards dollarization. This is particularly a worry in countries with weak policy institutions, etc. And so what I've been talking about in a global context then are risks of fragmentation, of undermining the domestic monetary policy system, of international payments, fragmentation, weak institutions, etc. This is all like the bread and butter of what the IMF is about, right? And as a result, at the IMF, there is an increased effort to do surveillance on this particular topic, and there are requests for technical assistance on fintech and on CBDC in particular. So clearly the IMF can help in terms of its analytical capacity and its convening power. But if you think further into the future, if such sort of coins would become more important in some future monetary system, there surely will be further implications for the international monetary system. And some people have played around with the idea of digital SDRs or ESDRs, and whether there might be some role for SDRs that is different from the very, very confined role that SDRs have today. So certainly, wherever we go, monetary is going to become more important in the future, I believe, so that the International Monetary Fund, the monetary part of that, will probably be more prominent over the next 10 years than, say, over the past 10 years. With that, thank you.
So thanks very much, Tobias. That was really interesting. As you were saying before the conference started, I mean, a lot of the issues here revolve around the details of the design of a CBDC or a digital asset. So it'll be interesting to hear the thoughts of others that have investigated this. Our next speaker is Ahmed Al-Khalifa, who is the governor of the Saudi Arabian Monetary Authority.
Well, thank you. Good afternoon. Let me at the beginning thank the Swiss National Bank and the IMF for organizing this conference and for inviting me to speak in this panel. I have 4 points to mention about the IMS and the impact of technological changes and whether it will enable for the future of the IMS or the other way around. Let me start with the benefits and risks of the digital financial innovations, some of which were mentioned by Charles at the beginning. Therefore, I can be short. In addition to that, a lot of work has been done on this topic in the last 2 years, either by the FSB or the BIS or by the IMF as well. The key benefits for the digital finance or fintech are, of course, its potential to reduce inefficiencies in and the cost of financial innovation. The fintech can promote also financial inclusion by enlarging access to financial markets and services, and that is very important for developing countries. And we heard the case of Kenya with the M-Pesa. As for the key risks, of course, the cybersecurity, also alluded by Charles, the cyber security, also the consumer privacy, which is very important, and you know the countries are differing on the stage of protection of consumer privacy. Some are in advanced stage, others are lagging behind. The AML and safety is very important. And the last but not least, the financial stability. If one of the three conditions were to happen, one of them is the creation of new forms of credit and liquidity, which we are not aware of. Second is the undermining the business models, including the profitability as well, of the current financial actors, banks in particular. The third is the lack of alertness on the part of regulators and supervisors to address the implications of the fintech developments. Another implication could be the damage to the smooth functioning of the transmission mechanism of the monetary policy as we know it nowadays. If banks might be crowded out by the digital financial system, that makes more use of the so-called decentralized financial technologies and less use of traditional central bank money. The materialization of such risks would not only affect the national economies, but would also might weigh on the smooth function of the IMS. The question was put to the panelists whether the digital finance carries risk of more frequent or speedier crises. The short answer would be it depends. If trust in the new providers of the digital finance would break down, and as we know it nowadays, it could be, it's a high probability, and if the herd behavior would manifest itself more quickly, there would be indeed more risks and more frequent or speedier crises. I think history holds some valuable lessons here when you think about the circuit breakers to halt abrupt price movements in the stock market. One option to alleviate some of the risks, which is to have central banks step up their involvement in the digital finance, including by switching to the issuance of its own digital currency. If it's not the central banks that are issuing digital currencies, the field will be left open to the private issuers. My second point is about the potential for digital currencies. Can crypto assets become serious competitors for the currently used international currencies in general, and the US dollar in particular, and as a result accelerate the move to a multipolar IMS? The simple answer would be I see little prospect for any private issuer of a digital currency to be able to offer the same store of value or the unit of account features and the lender of last resort facilities as central bank that is issuing the international currency. Of course, one needs, however, to be careful, as technology has a track record of producing real game changes. Yet, I do not see in the foreseen future a case of complete substitution or competition, all the function of digital money with the central bank money as we know them nowadays. The third point about the use of fintech by the central banks. I have no doubt that this is likely to increase in the near future. We have our position in that. In Saudi Arabia, we have the economic plan, that's the Vision 2030. Underneath that vision, 12 programs. One of the programs is the Financial Sector Development Program. One of the objectives of this program is to build innovative financial infrastructure whereby digitalization will play a role. In this context, in the Saudi Arabia Monetary Authority, that is the Central Bank of Saudi Arabia, we have launched together with the Central Bank of the United Arab Emirates a project called ABIR. Together with 6 commercial banks from both countries, we are conducting a proof of concept project using the DLT for both domestic and cross-border payments using common digital currency between the 2 central banks. The first use case of this project is to use the digital currency for payments between the 2 central banks, which will take place this month. The other use cases are payments between 2 local banks and commercial cross-border payments, which are planned for in July and August of this year. As cross-border payments today are mostly slow, costly, and relying on a correspondent banking network, we believe such new arrangements will help reduce counterparty risk, address inefficient liquidity management, and support the instant reconciliation of payment data. In addition to that, other objectives and benefits from the project ABIR is to test the capability of the technology and to understand the concept of digital currency and explore the potential backup system for the current RTGS as we have it nowadays. The final point is about the implementation of a more digitalized global financial system for the global cooperation. My main message would be to plead for more international cooperation, first in the area of exchange of information, second in the domain of making common assessments of the risks involved, especially for monetary and financial stability, which is our area of responsibility. Any fragmentation in our approach might lead to the global financial system to lose some of the benefits that the digital innovations in the financial sector could bring about. If we succeed in harnessing our efforts, then the prevailing IMS will be able to adapt fairly smoothly to the challenges posed by an increasing digitalization of the financial sector, just as it has been able to cope with the previous large shocks. I would like to conclude by noting that the existing IMS is operating fairly well, but it has room for accommodating itself to the digital era, provided it remains dominated by coordinated efforts by central banks. Thank you.
Thank you, Ahmed. So you've touched on a lot of the major issues here, and on the one hand, you point out that fintech can be used by central banks to increase the efficiency of the payment system. There are definitely issues on international cooperation, and actually a question that I think would be interesting to hear the people's comments on is whether the regulation of fintech is in some way fundamentally different than the problem that we've faced for a number of years of how to regulate the shadow banking system. Okay, our next speaker is Norman Chan, who's the Chief Executive of the Hong Kong Monetary Authority.
Thank you, Charles. First of all, let me thank Thomas and Christine for hosting this fantastic conference. It's very, very lively discussion, very, very fruitful. My comments really relate just to the CBDC. Charles gave a very useful overview, and Tobias, as usual, representing IMF, is many steps ahead of us. He's talking about synthetic CBDC. I'm a couple of steps behind, so I'll be just talking about the genuine CBDC as we know it. I would like to share with you our perspectives and views on these 3 issues. I don't think we have all the answers. It's too early to give the answers, but I want to share with you some observations on three issues. HKM has been very active. There are lots of excitement in Asia, at least, for central banks to be getting into this study research together with private sector technology companies into CBDC. We've been part of it, but these are kind of interim views on this issue. The first one, will CBDC displace conventional currencies? We talk about banknotes. And the second question, is CBDC just a technological innovation? You probably heard the speakers, probably not. And where does CBDC have the most promising prospects? I think the mixed views, and this is something which is a contentious issue. I think more work, more debate will be needed on this one. The first question, in terms of comparing with central bank currencies, central bank issue currencies, we're really comparing with physical banknotes, right? The physical one you use to pay and pay people. But in that sense, I think our view is that a digital CBDC, however designed, would only offer very limited benefits in terms of retail payment for domestic system. Why? Because in many countries, in Hong Kong, for example, the e-wallet, the digital payment, faster payment scheme would enable individual to make payments in domestic currency in split seconds. The difference would be 1 second compared with 3 seconds. So in terms of a digitalized CBDC, compared with banknote, yes, tremendous advantage. Compared with other electronic form or digital form payment, we think that the benefits were limited. And if you wish to design a retail system that is available to all the people on the streets, then the system, the scalability, the speed is a technological challenge in doing that. For large value, as we know, corporates use bank balances, bank liabilities to transfer, and is usually very efficient. And therefore, again, the benefits will be quite incremental. Now, the issue just been highlighted by some speakers is a lot of issue that on AML, CFT, investor protection, consumer protection, that need to be looked into. Because in banknotes, you can't conduct compliance check unless you get somebody on the spot and you ask questions. But for freely transferable CBDC at the retail level, you can't really do ex-ante compliance. Whereas in the banking system, the institution will be somehow accountable to the money they send through the system. They have to know the KYC, they have to do CDD, they have to report suspicious transaction to the law enforcement agency. But of course, post-events, after transfer, something goes wrong, I suppose the law enforcement authorities will be able to trace easier than banknotes. Banknotes, you can't simply trace them. So this is important AML safety implications that need to be addressed. I know that in some central banks, the research project is actually undertaken by the FinTech technology department. And I think it would be a mistake to do that, because it is not just a technological project. It's have wide implications for monetary policy and banking stability. I think this has been highlighted. I just talk about the technological challenge. If you want to have a decentralized distributed system for all the retail public, then the system will be gigantic. The technological challenge in doing an efficient payment system will be very enormous. But how about liquidity risk? In good times, normal times, it's okay because public corporates have confidence in the banks. They're quite happy to use bank balances to make the usual transaction. But in case of stress or a financial crisis, the switch from commercial bank balances in CBDC could pose great risk to banks in terms of liquidity and even solvency. Some talk about, can we not restrict issuance, the supply of CBDC? Yeah, I suppose you can do that. You have power to do that. But once you do that, when there's a high demand from the society, then you have differential pricing. CBDC would command a higher price than commercial bank balances. So you don't have a one-for-one kind of conversion. The monetary policy transmission mechanism will also be affected to the extent that if the public prefer to hold a sizable amount of CBDC as compared to commercial bank balances or commercial bank liabilities, the banks will have a small ability to create credit, and that will also have an impact on monetary transmission mechanism. The most promising prospect to me is not the retail, not the domestic RTGS, but cross-border. I think we all know, I think the current system is highly inefficient, highly costly. For those of you who have the experience of banking a check sent by somebody from the United States to Hong Kong, let's say Switzerland, a US dollar check, it would take 14 days if you're lucky, and maybe $50 to actually present it. It's a nightmare. For small value cross-border payments, I think it impedes on financial inclusion. Small guys, SMEs find it hard. Big corporates, $100 million, no problem, good service, real time. But otherwise, the service is very, very limited. And we don't have really good solution for that. And I think the e-wallet operators, in some cases, have presented some cross-border remittances, highly efficient, very low cost. But going forward, I think the CBDC, I've talked about, CBDC issued by central banks, would have a lot of benefits that can be presented in cross-border payments, both for large value as well as small value. Small value because it's convenient, large value because it's remove counterparty risk. But of course, you have a situation in which at the moment the regimes in the world depend heavily on institutions, intermediaries to do the checking, enforcement. You hold them accountable for wrongful remittances, transfers, but in a decentralized system, who will be doing that? I think this is a big issue that we need to address. Let me conclude. There's a little clock here, in case you don't know, that's the enforcement tool, Charles, for panelists to behave. I think CBDC have certain prospects, but central banks need to be proactive in either one of the two ways or both ways. Tobias talked about a synthetic CBDC. Lunchtime, we talk about a private sector operated digital wallet with backing, with fiat money backing, is stable coins, safe assets. If that's the approach for private sector to take a lead, but those issues I just highlighted, AML, cross-border, CFT, safe custody of the collaterals or the float need to be developed. We just can't let private sector to do everything on their own. What if people lose the money? They can't get the money back if the company go bust, just like banks. And therefore, I think central banks have a responsibility to think of some regime that could actually give sufficient protection to consumers and users of these digital currencies. The second approach, which is the one I talk about, is central bank actually issuing CBDC. I'm glad Tobias talked about this e-SDRs. I have the same thought. Clearly, dollar will be the kind of a candidate that people would use, private sector especially, to facilitate cross-border payments and transactions. But for people who really want to have stable bilateral exchange rate pair, a basket or SDR type would be an ideal candidate. But the same question, who would be the issuer? Who would be the trusted counterparty or central party to keep custody of those afloat will be an important issue. But the conclusion is that if the central banks or the authorities don't take a proactive step, I think the private sector will be miles ahead. And they are already doing a lot without, I think, an appropriate regulatory regime in place. I better stop here. Thank you.
Thank you very much, Norman. So it's, I think, a really nice way to put it, that a lot of times central banks' research has concluded that the CBDC is a really risky undertaking for a central bank. But you highlight that it's risky not to issue a CBDC as well, because then you've left it to the private sector, and then you need to worry about the regulation of the private sector. But now we have someone from the private sector. Brad Garlinghouse, who is the CEO of the financial technology company Ripple.
I will start off by also thanking Charles, thanking Thomas, thanking Christine. It's an honor to be included. And as was introduced, I think they saved me for last so that I could talk about the private sector version of this. I also start by kind of explaining the basics of what Ripple is and what Ripple is not. Ripple is a private company. We're based in California, about 300 or 400 employees around the world, and we're trying to solve a problem. We're selling technologies to banks and financial institutions to solve a cross-border payments problem. To be clear, we have not focused on the central bank digital currency issuance. Our view is very much there needs to be interoperability globally. And even in a world of CBDCs, you still need interoperability to solve that problem. Also, before I dive in, my comments are more focused on kind of explaining how Ripple's approaching this problem as opposed to just CBDCs. But I thought it worth spending a moment on how we think about blockchain at large and why it is such an interesting technology and I think appropriate for central banks and commercial banks to be looking at. For me, the novelty of any blockchain technology is the ability for two parties to transact without trust, but with certainty. So today, anytime we transact, we are transacting through a central counterparty, whether that be a correspondent bank where Ripple is focused, or that be a Visa or American Express, what have you. The opportunity around blockchains is to change that dynamic, and I think many industries, whether it's payments, what we're talking about today, or securities, or even loans, any of those transactions, I think, can be disrupted and made more efficient through blockchain technologies. All right, so with that kind of brief introduction, I'll be brief on some of my comments here because we've touched on this already. I think we would largely have few arguments with the idea that global payments today have not caught up with the age of the internet. We talk about slow. We've talked about the 14 days that Norman mentioned. The younger generations today are accustomed to be able to open up their smartphone and click on a button and have an ice cream delivered in 20 minutes. They aren't going to be very happy when it takes their payments, days and lots of costs to get to them. Another thing that is, I think, often lost upon us is the opaqueness in the problems with which correspondent banking currently operates. There's a 6% error rate self-published that 6% of all SWIFT transactions require human intervention. Now, that doesn't mean they don't get there. It just means that human intervention adds time, it adds cost, and what have you. And lastly, when we talk about cost, it isn't just about transaction fees. It's also about the pre-funding required for commercial banks and even large corporations and the cost of that capital. What's amazing to me is that these costs are often borne or burdened the populations that are least able to afford them. Data from the IMF and the World Bank would say that the average remittance costs around 600 basis points in a world where we think about the internet enabling kind of real-time instant information. Why can't we use these new technologies to build an internet of value? When we look at the current dynamic I was just talking about, the pre-funding, if the correspondent banking network requires this pre-funding, I'm not talking about a central bank level, but as much as I'm talking about it at a commercial level. And oftentimes, even when I'm meeting with senior people at various banks or financial institutions, they'll talk about their cost to fund into the Mexican peso, and they'll cite a very, very low number. But what that doesn't include is the cost of capital that's sitting at a bank there. It also restricts competition because it requires capital to get it there. Our view in the future is you don't have to have this pre-funding, and instead you can use a digital asset to have global liquidity on demand. Now, we build upon a tech stack of an open source technology called XRP. XRP originally was built by some engineers who had seen some of the flaws of Bitcoin and the challenges of scalability around Bitcoin, where Bitcoin today, on a per transaction basis, it's rather slow and rather expensive. XRP is very, very fast, about 1,000 times faster per transaction and 1,000 times cheaper per transaction. The other dynamic, of course, of correspondent banking is some of the more quote-unquote exotic currencies, exotic corridors have been left to kind of stand on their own. And the liquidity in digital assets could be applied to actually make that much more democratized and a level playing field. Ripple's vision from the beginning really has been to apply these technologies in the same way that TCP/IP and HTTP are the technologies underpinning the Internet of Information. These blockchain technologies will be the underpinnings of an internet of value. where we have connected devices, we have connected information that will allow payments to flow. And as Norman was describing, if you're a large corporation moving $100 million, that's one thing. If you're a freelancer working in the Philippines doing design work for a company in London, and you want to get paid $30 or 30 pesos, Philippine pesos, that's not a transaction that can easily be enabled. And in fact, for the companies that enable that, they require the freelancer to set up an account, and they don't actually pay it out until there's roughly 1,000 USD sitting in that account, and then they would pay it out. So Ripple has come to the market with 3 products, and I will just briefly touch on them. The first one is called Xcurrent, and the reason why I'll point this out is because Xcurrent doesn't touch crypto. Xcurrent is just kind of Swift 2.0. It's a messaging framework that is much more efficient and real-time as compared to fiat to fiat. That typically is how we start working with any bank or any financial institution, is on a fiat to fiat basis. The bottom product we see down here is called XRapid, and XRapid is really where we use XRP to fund real-time liquidity. We brought this product to market in Q4 of last year, and immediately we saw the demand for that type of product from banks, financial institutions who want to open up new corridors for payments, but don't want to open up new nostro-vostro relationships and the friction and overhead that goes with that. The third product is really simply an API that allows corporates to do real-time payouts into this network we call RippleNet. The challenge here, as many of you may know, is there's corporations ranging from Uber to Amazon to less technically efficient companies. They employ hundreds of engineers that just integrate into payment networks around the world. They're building custom APIs into payment networks in the Philippines or Indonesia, into the Middle East, what have you, so they can enable those payouts. We think by standardizing on an open source API, we can make that more efficient for everyone. We've been fortunate, and actually, I meant to say up front, I had a very good conversation before we started this panel. One of the things I worry about when we talk about blockchain technologies is sometimes they are a solution in search of a problem instead of a problem in search of a solution. There's many times when people come and talk to me about blockchain solutions, and I ask them, why can't we just use a database? Why is a blockchain a better solution? And in Silicon Valley, where I've been for 22 years, sometimes it's catnip for investors. It's just to get investors excited, where a database would be more efficient. Now, the reason why I offer these remarks at the beginning of this slide is I think one of the reasons why Ripple has done well is we've been very focused on solving a specific problem for a specific customer, and we've been focused on that for a long time. And we've been fortunate, therefore, to get about 200 customers globally now working with us in one way or another. So I'll conclude just by saying I think the excitement around blockchain is well-founded. And it will impact many, many industries in the same way the Internet of Information 20 years ago has impacted many, many industries. But I also think sometimes that the hype gets ahead of the reality, and we need to be clear about what problems we're trying to solve, whether it's at a central bank level, a commercial bank level, or in other industries altogether. With that, I will turn it back to you, Charles.
Thanks very much, Brad. Well, I'd like to hear more about that. It certainly sounds promising, and I think we'd all like to know more about how counterparty risk is avoided here, and the problems of foreign exchange liquidity. And I think that's a conversation that will continue. But I think next I'll open the floor to questions. So, Agustin.
Thank you very much. Very brief reactions to some very rich panel. First, with respect to your introductory remarks, Charles, something that for me just didn't sink in very well is this idea that CBDC could be an easy source of financing for the government. I mean, in most central banks, the first no-no is to finance governments. And I think one of the issues of CBDCs that has been, especially depending on the shape, is that it might crowd out the transactional deposit base of banks, which are efficient at intermediation. Now, the question is, well, CBDC might disintermediate banks. That's some serious concern, but then disintermediate them to finance the government, that's even more difficult. So that's a first issue I found. Then, we need to think very careful about what should motivate our progress in this area. And I subscribe a little bit what Brad said. Oftentimes we're looking for a problem to use some technologies. It sounds a little bit to me that that's your proposal, Tobias. I mean, I think that at least the issues you plan to address pretty much all have been solved without making, for example, central banks from being issuers to being the auditors of wallets, no? That's in a way what you want us to make now in terms of certifying that the backing is there fully. I think those problems have been solved, are solvable right now through two-tier system, open to many participants, not only banks, can give pretty much all these solutions without majorly affecting the way central banks operate. Even I think the problem that Norman is thinking about can be solved, not necessarily issuing central bank digital currency. So my point is, and when I speak later, I will talk more about this, but I think, yes, we should be very open to technology, but first we need to think about the economics, if it really makes economic sense to move forward in that respect. Thank you.
Okay, let me take Thomas Jordan, and I have a couple of others, but maybe let's hear from you, and then we'll get some responses.
Well, thank you, Charles, and thank you very much for these excellent presentations. I have two remarks and two questions related to these remarks. The first to Charles. Well, you made a very good introduction, and the key really is who should have access to central bank money. This is the key question. And in that respect, it's really what is the role of the state and the central bank in that sense? Should we provide a means of payment, a safe, stable means of payment, a unit of account, or is our role to provide an unlimited safe asset to everybody? And this is a huge distinction. And if the second is our role, then we may end up really with the ultimate holder of risk. If in a certain situation, everybody wants to have, as a counterparty risk, the central bank, then we have to provide all those safe assets. So I think the really fundamental question is, what is our role? Is it more a safe means of payment, stable, or is it really that we should provide everybody unlimited with a safe asset? And then, but maybe you could comment, Charles, on that point. And the second one for Tobias, in your description about these stable coins, what actually is the difference between, in an economic term, not in a technological term, between a bank deposit and a stable account, a stable coin? Is more or less the same, and that would also, in a way, implicate when we start from the principle, same activity, same regulation, that in fact, at the end, we should have a very similar regulation regarding these stable coins as we have already now for bank deposits.
Well, why don't you go ahead and go first?
Okay, so three things. So I think it's important to look at the whole world, and a large part of the population in the world doesn't have access to bank accounts, and even if it does have access to bank accounts, those are extremely expensive. It's expensive to make payments, wirements, international payments. So I think one of the big motivations for this new technology, right, because Agustin is asking why, is that there's huge financial exclusion, and these technologies have proven to increase financial inclusion enormously. So I think you have to look broadly around the world. I think this is one motivation, and I think the Ripple example is one example, and Norman has talked about that, is that international payments are very expensive, and the structure is not very well built. Secondly, about the synthetic CBDC, and I just learned this morning that you actually have a special purpose license in Switzerland where fintech institutions, as far as I understand, can deposit money with the central bank. And in principle, I think that goes a long way to create something pretty close to the synthetic CBDC, where by synthetic CBDC I mean that you have a digital currency that is deposited with central bank money. Of course, there are other trust issues that I talked about that need to be solved, and they're, to make this as safe as true CBDC, there are bankruptcy issues. There are lots of issues. So, it's not that easy, and the devil is in the detail in all of this. But I think that given this special purpose license, you're actually pretty close to being able to do this in Switzerland. Thirdly, I mean, is there a problem to be solved? I think the world is moving to becoming more digital. I mean, the way that we are transacting today is very different from the way we transacted 20 years ago. And I think in 10 years, we will just interact in very different ways. And I think at some point people will say, cash, I mean, why could you ever have had cash? It's a very weird instrument when you think about it. If we were today debating, should we introduce cash? I mean, it's not obvious that you would actually want to do that. It has many, many shortcomings. Whereas I think, there is a digital revolution underway, and I think it's very natural to think about what that means for money. And of course, I mean, in systems such as the European Union, where you have instant, pretty much costless transactions, retail size, you don't have to solve many of these problems. I completely agree. And, it's in the broader world that I think many of these motivations come from.
I want to quickly answer the question that Augustin posed to me, but I'm going to turn the one Thomas posed to me over to Norman Chan. But, when I said it would save governments money, I wasn't suggesting that, great, we can start creating money and finance yourself. I just meant it saved us money in the same way that it saved government money in the same way that an open market operation does, that the interest paid on reserves is lower than the interest on treasury bonds, and that was all I meant by that bullet point. But I'd like Norman to address the question of should central banks be only offering a stable currency, or should they also offer a safe asset? And Hong Kong's had a stable currency for many years.
Yeah. Can I, before I comment on that, I think we must distinguish the debate between whether you have, let's say, physical currency, banknotes for transaction as digital means of payment. I don't think the debate's about whether it's physical banknotes versus digital. The world is going digital. The issue is whether the central bank should step in to actually be more proactive to, let's say, compete in some way with e-wallet operators. E-wallet operators are very efficient now, and many banks are also very efficient in making retail payment in split second, as I said. So it's totally digitalized. So there's no problem with that, about efficiency, speed, and cost. The problem is whether in cross-border context, you need to depend on bank liabilities to make the transfer. And you have a lot of issues about inefficiency, layers, corresponding banking. Brett talked about this opaqueness, take a long time, financial exclusion. But whether CBDC using DLT would provide a better answer, that's the question I'm talking about. I think there's a lot of prospect in that, but it doesn't mean it can be achieved tomorrow, both technologically and also regulatory regime. If the private sector continue to move ahead, they'll be ahead of us. I don't think there's a kind of regulatory regime that is designed to oversee the kind of stable coins transfer system. Do you regulate them as banks? You talk about? Maybe, maybe not. And who is going to ensure the public, the float, the backing is actually there when they redeem, right? We as supervisors would actually ensure banks will have the money there to pay back with depositors. But how about these private sector issuers? So the question is really about whether central banks should do more, either collaborating with private sector to facilitate them to move ahead in a kind of a more controlled and safer manner, or central banks should just step in and say, look, we, central bank, would do the issuance using DLT, overcoming those problems we talk about in cross-border payments. Safe assets, I don't know, it's a hard debate, because if the public suddenly say, I have lost confidence in the banking system, I want to withdraw my balances with banks, with banknotes, would you deny that? So the question, do you really have control over the amount of issuance in the central bank liabilities? In good time, you say, I'm going to deal with banks. But in bad times, do you have a choice? I know banknotes are very cumbersome, expensive to store. But in case of stress, the public may say, I want banknotes. I trust nobody but the central banks. And that control is probably, I suppose, is very, very tentative.
Okay, I've got Governor Olson and Barry Eichengreen.
Okay. Well, Øystein Olsen, Norges Bank. Well, my question or comment perhaps was very much related to those of both Augustine and Thomas. It was triggered by your intervention, Tobias. All very interesting. The future is difficult, the complex with the technology. But my question is really, you talked about the e-money. I take it that you refer to some kind of new providers of e-money, because I mean, as already mentioned, it's not about cash. We have most of our transaction now is in terms of digital money, based on when we draw on bank accounts, and you know, my money as a concept is a strange thing. I think most people think that when they think it over. Fiat money, ordinary fiat money, are created when credit is given, and I guess when I think about this, what's really important, especially on the role of central banks. It's about confidence. It's about trust and confidence to the value of money, and to the existence, to the concept of money and the monetary system. So. I'm not at all an expert on the technology. The technology is new. There are new possibilities there. But to some extent, I feel that when we discuss the structure and the role of the central bank, it may be that a history repeats itself, and it's really about whether you should have a decentralized system of money providers, or whether the central bank should have the same central role as it has had. Thanks.
So we're running a bit short on time. I've got Barry Eichengreen and Dirk Niepel. So let me collect those questions, and then we'll see where we stand.
So I have a quick observation and a question. Last year I had a fellowship at the Bank of England for a month, and I had to pay my rent in advance. It cost me $10 and took me 24 hours to transfer the money from Bank of England to Santander UK. So I'm not going to tell you what the platform was. You know what my banks are. The problems with that transaction were that the money was uninsured for the 24 hours that it was in transit. And $10 may still be a lot of money for the Philippine copy editor, but I think there's a tendency to overstate the gravity of the problem. The question, and Brad, this is an honest question. Ripple is, one of your products is to distribute liquidity through the payments system. So the question is, could there be a run on Ripple? In other words, everybody wants your liquidity. Nobody wants to provide it because there is a scenario where people develop doubts for good reasons or bad about the system.
So let me first clarify what Ripple provides. Ripple doesn't provide liquidity. Ripple provides technologies that allow you to access liquidity that exists in the marketplace. In the last 24 hours, the digital asset marketplace traded about $50 billion of liquidity in 24 hours. That includes XRP, but that includes Bitcoin and Ether and what have you. So, could there be a run on digital assets at large? The nuance of the question is, Ripple sells technologies. Can there be a run on Ripple? I don't know what that looks like. I mean, I can't really think about that. could there be a run on digital assets? I don't know. I mean, today, again, $50 billion of liquidity, and, people are moving liquidity around. For XRP, a settlement happens in 3 seconds. And so, to your point of taking 24 hours, I mean, 24 hours that's a positive story of a cross-border transaction. Many take longer. So taking a 3-second transaction and the risk associated with a 3-second transaction as compared to a day or 2 or 3, I think most people would say, hey, I feel better about taking 3 seconds of risk than a day or 2. So could there be a run on digital assets? Even that, I don't know exactly how to think about, because again, there's a lot of, I suppose at $50 billion a day in a nascent, I view it as a pretty nascent market today. And people are getting liquidity that exists in the marketplace in local regions between XRP and the Philippine peso, XRP and the Argentine peso, XRP and the Brazilian real, and it's tapping into that liquidity that exists in the marketplace.
Let me take Dirk Niepelt's question as the last one because we're slightly past time here.
Thank you, Charles, and thanks for mentioning the reserves for all. So Dirk Niepelt, Study Center Gelsenkirchen and University of Bern. I want to offer one comment on this notion that is very frequently voiced, that CBDC would undermine financial stability, and I think I would like to argue that the opposite is actually the case. And there's an accounting part to the argument, and there's an economic part to the argument. The accounting argument is simply what is happening if somebody wishes to transfer funds from a bank account into CBDC. What is happening is that the central bank acquires a claim vis-à-vis the banking system as the counterparty of that transaction. So that means that the banking system doesn't lose any funding, it simply changes the composition of its funding. So you might argue this has consequences, it certainly has, but there's no notion of funding breaking away from the banking system as a response to an expansion of CBDC. And the economic argument is that on top of that, what is happening in the process is that the central bank is gaining importance as a creditor of the banking system, which has, of course, many implications. But on the financial stability side, probably it has positive implications. Rather than having many small depositors, what you would have is one large creditor. And this large creditor is internalizing run externalities, and it's much likely to run. And the system is much more stable as a consequence. So all in all, the financial stability argument, I think, is very much overstated. On the other hand, and that comes back to what Thomas said before, of course, the question is, do we want the central bank to take a bigger stance and a bigger role in the banking system? Do we want that? And there's many political economy arguments that would lead you to say, no, we probably don't want to do that. But all I want to say here and point out is that the financial stability argument, I think, is a non-starter if you want to discuss CBDC. Thanks.
Well, I think we need to wrap up. Let me just see if anyone has any final comments. And they're distributing sweets and coffee, so everyone should be in a better mood. But let's see if would anyone like to add anything? Okay.
I reserve the argument on this financial stability point, because for us, if we swap, I will deduct the balance, the reserve that the bank holds with us. That will actually lead to a shrinkage of the balance sheet of the banks. So I'm not going to hold the commercial bank claims on my balance sheet. You see what I mean? So there's a point of contention. We'll have a bilateral discussion afterwards.
So I would just add to Governor Olson's question about confidence and trust. So I think we are in a period of technological disruption, and it's difficult to see exactly how the financial system is going to look like in 5 or 10 years. But clearly, central banks have a role of guarding financial stability, and to the extent that we do see in many countries that these e-monies are coming and that all kinds of innovation is taking place, I think that inexorably there will be some role for central banks in there. And I think it's particularly in the countries where these e-monies have a huge market share that the central banks are particularly concerned.
Okay, great. Thanks very much.